Did you know that the average stock market return is about 10% per year? That might not sound like much, but it's enough to turn a small investment into a life-changing amount of money over time. In this video, I'm going to break down the 12 secrets that helped me build my 7-figure portfolio in record time. So buckle up, grab a notebook, and get ready to take some notes because this is going to be a wild ride. Before we get into the good stuff, let's address common misconceptions and challenges in stock market investing. Fear is a big hurdle. Market crashes make people think it's too risky. But not investing is risky too. You don't need a lot of money to start. Small, consistent investments grow over time. Investing isn't just for finance experts. Anyone can learn and start investing. Approach investing with the right mindset. Learn, adapt, and stay disciplined. Ready to unlock your investing potential? Stick with me. Now let's talk strategy. When I first started investing, I was all over the place. I was chasing hot tips, buying into hyped-up stocks, and basically treating the market like a casino. My turning point came when I realized the importance of thorough research. I started spending hours every day poring over financial statements, analyzing market trends, and really understanding the businesses behind the stocks I was considering. One of my go-to resources was the Securities and Exchange Commission's website, or SEC.gov. I also became obsessed with reading books and articles by investing legends like Warren Buffett, Benjamin Graham, and Peter Lynch. But here's the thing. Research isn't just about crunching numbers and reading dusty old books. By connecting the dots and seeing the forest for the trees, I was able to identify promising investment opportunities that others might have missed. So, I was neck-deep in research, devouring every bit of information I could find, when I stumbled upon a concept that would change my investing journey forever: index funds. Now, I know what you're thinking. Index funds? Graham, that sounds boring. Where's the excitement? Where's the thrill of picking individual stocks? And you know what? You're right. Index funds aren't sexy. They're not going to make you rich overnight, but that's precisely why they're so powerful. See, index funds are like the tortoise and the hare story. They're slow and steady, but they consistently outperform most actively managed funds over the long term. Here's how they work. An index fund simply tracks a specific market index like the S&P 500, which is a collection of 500 of the largest publicly traded U.S. companies. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all those companies. This diversification is key. By spreading your money across hundreds of stocks, you're minimizing your risk. So I was neck-deep in research, devouring every bit of information I could find when I stumbled upon a concept that would change my investing journey forever: index funds. Now I know what you're thinking. Index funds? Graham, that sounds boring. Where's the excitement? Where's the thrill of picking individual stocks? And you know what? You're right. Index funds aren't sexy. They're not going to make you rich overnight. But that's precisely why they're so powerful. See, index funds are like the tortoise and the hare story. They're slow and steady, but they consistently outperform most actively managed funds over the long term. Chapter 4. Diversification. Don't put all your eggs in one basket. You know the old saying, don't put all your eggs in one basket? Well, in the world of investing, that's not just a catchy phrase. It's the golden rule. Diversification is the key to mitigating risk and protecting your hard-earned money. Think of it like this. If you invest all your money in a single stock, no matter how promising it seems, you're essentially putting all your hopes and dreams on the success of that one company. If something unexpected happens, like a major product recall or a sudden shift in the market, your entire portfolio could be wiped out. That's why it's crucial to spread your investments across different asset classes, industries, and geographies. Don't just invest in stocks. Consider adding bonds, real estate, and even alternative investments like precious metals or cryptocurrencies to the mix. Within each asset class, diversify even further. This way, if one sector takes a hit, the others can help cushion the blow. Chapter 5. Long-term perspective: patience pays off. In the age of instant gratification, it's easy to get caught up in the allure of quick profits and overnight riches. But let me tell you, the stock market is not a get-rich-quick scheme. It's a marathon, not a sprint. One of the biggest mistakes I see investors make is trying to time the market, jumping in and out of positions based on short-term fluctuations. They see a stock going up, they get excited, they buy in at the peak, and then the market corrects itself, and they panic sell at a loss. Trust me, I've been there. Early on in my investing journey, I was glued to my trading screen, constantly checking prices and making impulsive decisions based on emotion rather than logic. It was exhausting and it was costing me money. That's when I discovered the power of a long-term perspective. Chapter 6. Risk Management. Protecting your profits. Now let's talk about something that keeps most investors up at night. Risk. We all want to make money in the market, but no one wants to lose their shirt in the process. That's why having a solid risk management plan is crucial. The first step is to understand your own risk tolerance. How much volatility are you comfortable with? What's your investment timeline? Once you have a clear understanding of your risk appetite, you can start building a portfolio that aligns with your goals. Chapter 7. Continuous learning, stay ahead of the curve. The stock market is constantly evolving. New technologies emerge, industries are disrupted, and economic landscapes shift. That's why continuous learning is essential for any investor who wants to stay ahead of the curve. Think of it like this. The moment you stop learning is the moment you fall behind. The most successful investors are lifelong learners, constantly seeking out new information, challenging their assumptions, and adapting to changing market conditions. So, how do you stay ahead of the game? First and foremost, make it a habit to read. Subscribe to financial publications like the Wall Street Journal, Bloomberg, or Investors Business Daily. Read books by renowned investors and financial experts. Follow industry blogs and podcasts. But don't just consume information passively, engage with it. Chapter 8. Patience and Discipline. The keys to long-term success. We've talked about research, diversification, and risk management, but none of that matters without two crucial ingredients: patience and discipline. These are the qualities that separate the successful investors from those who get sidetracked by emotions and end up making costly mistakes. Patience is essential because building wealth in the stock market takes time. Don't expect to get rich quick. There will be ups and downs, periods of rapid growth, and periods of stagnation or even decline. The key is to stay the course, trust your strategy, and resist the urge to make impulsive decisions based on short-term market fluctuations. Discipline goes hand in hand with patience. It's about sticking to your investment plan even when it's tempting to deviate. Chapter 9. Financial Goals, your roadmap to success. Before you even think about buying your first stock, you need to define your financial goals. What are you saving for? A down payment on a house, early retirement, your dream vacation, your kids' college fund? Having clear financial goals is like having a roadmap to your destination. It gives you direction, helps you stay motivated, and allows you to track your progress along the way. Once you know what you're working towards, you can start developing an investment strategy that aligns with your goals. Your financial goals will also influence your risk tolerance. Chapter 10. Market Analysis. Understanding the big picture. Now that you have a solid foundation in investing basics, let's talk about market analysis. This is where you put on your detective hat and start digging into the factors that drive market movements. There are two main types of market analysis: fundamental analysis and technical analysis. Fundamental analysis focuses on the intrinsic value of a company, looking at factors like earnings, revenue, debt, and management quality. Technical analysis, on the other hand, focuses on chart patterns, trading volume, and other market indicators to predict future price movements. Both approaches have their merits, and many investors use a combination of both to make informed investment decisions. Chapter 11. Emotional control. Don't let fear and greed drive your decisions. Investing is as much about psychology as it is about numbers. Fear and greed are two of the most powerful emotions that can cloud your judgment and lead to costly mistakes. When the market is going up, it's easy to get caught up in the euphoria and start making impulsive decisions. You see others making money and you don't want to miss out. This is known as FOMO, or fear of missing out, and it can lead to buying high and selling low, which is the opposite of what you want to do. On the other hand, when the market is going down, it's easy to panic and sell everything, locking in your losses. Fear can be paralyzing, preventing you from taking advantage of buying opportunities when prices are low. The key to emotional control is to have a plan and stick to it. Don't let your emotions dictate your investment decisions. Chapter 12. Networking, the power of community. They say it takes a village to raise a child, and I believe it takes a community to build wealth. Surrounding yourself with like-minded individuals who share your passion for investing can provide invaluable support, insights, and opportunities. Networking can take many forms. You can join online forums, attend industry events, or even start your own investment club with friends or colleagues. The key is to find a community where you feel comfortable asking questions, sharing ideas, and learning from others' experiences. One of the biggest benefits of networking is the opportunity to gain different perspectives. So there you have it, the 12 secrets that helped me build a $1 million stock portfolio in just 3 years. It wasn't always easy, and I made my fair share of mistakes along the way. But through it all, I learned the importance of discipline, informed decision-making, and a relentless pursuit of knowledge. Remember, investing is a journey, not a destination. And don't forget to subscribe to my channel for more tips, insights, and strategies to help you achieve financial freedom.